Hello to the listeners. A very welcome to Truss Talk. I'm Jason Nichols, partner at Truss Financial Group. I spent my morning talking to an investor who owns 15 doors and was just told by his local branch manager that he's over-leveraged. And what's interesting is, when we actually broke down his numbers, every single property was cash flow positive. The issue wasn't risk. The issue was interpretation.
And I'm Jeff Miller, CEO of Truss Financial. That over-leveraged comment is the retail bank's way of saying, we don't know how to read your balance sheet. After 30 years in this mortgage game, I've realized that retail banks and real estate investors are speaking two completely different languages. One is looking at income streams and asset performance. The other is looking at static ratios designed for salaried employees.
Yeah, it's 2026. The market is moving fast. Opportunities are everywhere. But if you walk into a big retail bank as an investor, it feels like you're walking into a brick wall. Not because your deal is bad, but because the system you're walking into wasn't designed for someone like you.
Today, we're exposing why the Big Four and your local credit unions are officially breaking up with real estate investors, and why that might actually be the best thing to ever happen to your portfolio. Because once you stop relying on retail banks, you start operating with lenders who are actually aligned with how investors think.
Jeff, let's talk about the debt to income. You know, the DTI trap. This is where most investors get killed at a retail bank. DTI was never built for scaling portfolios. It was built to protect banks from overextending individual consumers.
Yes, exactly. Retail banks use consumer underwriting. They are looking for a nice, clean W-2 and a low credit card balance. When an investor walks in with 5 rental properties, the bank doesn't see assets. They see 5 potential liabilities. They're not factoring in that each of those liabilities is backed by an income-producing asset.
They see 5 mortgages, 5 property tax bills, and 5 insurance premiums. And even if those properties are netting you $2,000 a month each, the bank's old school math often discounts that income by 25% or more just for vacancy factors. Even if your properties have been fully occupied for years, the system still assumes instability.
So on paper, the bank thinks you're losing money. It's insane. You could be generating consistent monthly cash flow, building equity, and still look risky on paper. You're building a kingdom, and they think you're a risk.
And then there's the exposure limit. Most retail banks have a hard cap. Once you hit 4 or 10 finance properties, they cut you off. They don't care if you have $10 million in the bank. Their manual says no more loans, and there's no flexibility there. It's not a conversation, it's a hard stop.
That's because retail banks aren't set up for growth. They're set up for stability. They want boring. But real estate investing is a business. It requires a lender who understands DSCR, debt service coverage ratio.
This is the Truss way. We don't care about your personal DTI. We don't care how many properties you already own. We look at one thing. Does the property pay for itself?
If the rent covers the mortgage, the taxes, and the insurance, the deal is done. We qualify the property, not just the person. That is a language a retail bank simply doesn't speak.
So true. And in 2026, the big banks are also terrified of the commercial cliff. They are tightening up because they're worried about office buildings and retail spaces. Unfortunately, they're painting residential investors with that same broad brush.
Yeah, they're retreating. But while they retreat, savvy investors are advancing. At Truss, we have access to private capital and institutional lines that are hungry for residential rentals.
If you've been told no because you have too many properties, or because your tax returns show too many write-offs, or because you're too complex, understand that it's not you, it's them.
Stop trying to fit a sophisticated investment strategy into a starter home bank.
If you want to scale in 2026, you need a partner who sees your portfolio as a powerhouse, not a problem.
Call us. Let's look at your DSCR and get your next deal closed while the retail banks are still stuck in committee.
Thanks for listening to Truss Talk. We'll see you next week.